Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my weekly video about my thoughts on market happenings for the week ending October 1st, 2021. All the US and Canadian indexes were down for the week, but oil was up by a small amount. On Friday was the US government shutdown deadline, but the US passed the government funding bill with hours to spare to avert the shutdown. As for the 1 trillion bipartisan infrastructure bill, the House Speaker Nancy Pelosi expected it to be passed this week, but it wasn't, and voting was pushed back. The Senate had already passed the measure in the US. The US weekly initial jobless claims were 362,000 versus 335,000 estimates, so higher than expected. And the existing claims were 2.802 million versus 2.82 million of the previous week. The GDP is an annualized 6.7% growth. Looking at the US Treasury yield, the 10-year US Treasury yield spiked to 3-month highs above 1.567%, which slammed tech stocks on Tuesday, but the yield has since retreated. The 10-year US Treasury yield increasing on economic optimism and inflation fears as the bonds build in inflation expectations remained above 1.5% on Tuesday, back to levels not seen since June. Higher bond yields, which move in the opposite direction of prices, can put pressure on tech stocks by exposing their high valuations, as I'll discuss in a second. As the 10-year US Treasury yield approaches 2%, it is a warning sign that investors are selling safe bonds and getting into risky stocks. So this is a risk-on trade. The yield ended the week at 1.46%, however. Turning to interest rates and inflation, tapering in the US could start with renewed confidence that the economy could weather slightly higher rates, perhaps as early as this fall. Higher inflation for a longer period or permanent, not just transitory, will cause interest rates to go up. Inflation is expected because of supply chain issues all over the world, US increase in minimum wages, which is all likely to be spent, and this is all causing money chasing fewer goods, and the money printing all over the world isn't helping either. Tech and other high growth, high multiple sectors and stocks will often see a negative reaction when interest rates rise, and the stock valuation will fall. Indeed, higher rates make the future earnings prospects of those companies less attractive to investors. Quote, as interest rates rise, the importance of near-term cash flows for valuations rises, resulting in relative underperformance for longer duration stocks like tech, at least in the near term, end quote. Chris Hussey from Goldman Sachs said in a note on Tuesday. Industrials and value stocks will do better. Banks and financials, with increasing rates, will do very well. This would bode well for banks as they can increase their net interest margins, so I remain positive towards Canadian and US banks. Insurance companies will make more return on their safe investments of our premiums and will also do better in increasing interest rate environments. The prediction is, however, that as supply chain issues resolve themselves, inflation pressures will ease somewhat. The job growth will accelerate now that the US COVID benefits ended on Labor Day, and there may be many more job seekers and available employers that are having trouble finding employees will benefit by actually being able to find employees. Finishing up with oil, as there are very few projects to add to oil infrastructure and oil companies are being frozen out of new investment, and by this lack of new money, as well as regulations being made to convert to renewables. Until the renewable energy infrastructure is in place, which could take a long time, there is going to be a supply/demand imbalance. which is already showing itself in oil prices, lower inventories, lineups at gas stations in the UK, high energy prices in Europe, and rolling blackouts in China. A bit of an energy crisis might show itself until supply and demand even out and even more infrastructure comes online. So this has been my week in review. If you have any questions about what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.